Okay, investors are weighing the possibility, speaking of the presidential election, the possibility of a second Donald Trump presidency. And that's after that shaky debate performance by President Joe Biden. Our guest says investors are being cautious because of the state of U.S. politics, the economy, and uncertainty over Fed rate cuts. Let's bring in Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. Andrew, it's always great to see you. I am seeing commentary on what happens if Mr. Trump is returned. And apparently he would press ahead with a renewal of tax cuts. And of course, that would tend to worsen the U.S. budget deficit.
Well, Andy, on a day like today, where we've already seen the budget deficit for this year revised higher to $2 trillion, we're now talking about additional tax cuts, putting probably another close to $2 trillion or more on top of that. So investors are genuinely, and I think correctly, concerned about what the fiscal state looks like going forward. Again, keep in mind that the U.S. right now is running a budget deficit of about 8% of its economy, which, anywhere else in the world, we would be decrying as fiscal mismanagement, and we would be looking at bond markets in disarray. We've seen a little bit of pressure on U.S. bonds right now, but I think investors are correctly looking at this as a risk going forward.
It's fascinating, isn't it? That, just as you say, if America didn't have the world's reserve currency, they could be in trouble in terms of international sentiment on their economy.
Well, absolutely. And of course, that gets us into the whole ballgame of in 2025, if this were to materialize, and if we were to see deficits increase by the magnitude that they could, investors are going to start looking at the potential for downgrades. And we've been down this road many, many times before. But we're looking at a situation now where the economy is already starting to show signs of weakness. We've been talking about slowing activity for a number of weeks now. Interest rates not coming down as quick as perhaps market participants would like. And of course, we've heard Jay Pyle talk about a hesitancy continuing with that regard. But now on top of that, Andy, you're going to layer in risk premium on longer term debt. And those higher yields could put additional pressure on an economy, which, again, at the end of the day, is not going to be conducive for the sustained stock market performance that we've seen this year.
Perhaps paradoxically, despite all this tension over politics in France and the U.S., volatility in the market low?
Yeah, and that's the strange thing. I think this week we could see volatility perk up a little bit more just because we've got a holiday shortened week. But consider this, Andy. We're looking at the VIX index right now, trading at levels close to the lowest that we've seen in about 5 years, despite the fact we've got uncertainty on both sides of the Atlantic with respect to politics. And I would say also uncertainty with respect to, where interest rates are going to go and where the global economy goes. So, we've been here before where volatility gets compressed to levels that are extremely low, usually is a precursor to something that causes that volatility to move higher. I'm not saying that's going to be the case in the coming weeks or months, but definitely something that we have to look at as we move closer to November.
What about the big tech names, Andrew? Is that party over, or should people stick with it for now? Maybe we can put up a 5-year chart for the NASDAQ 100.
Well, I think the party is over only when we start to think about long-term interest rates being substantially higher than where they are right now. And, to the extent that we've seen rates push higher in the last number of sessions, we're not at levels right now that would trigger any level of concern in the high duration stocks that we look at, or in this case, large cap tech. So I don't see any immediate risk to the sector going forward. I think there's a very solid momentum play that investors can still play with. We still like the sector. It's really the other areas of the market that are going to be more sensitive to a decay in economic growth, whether we're talking about machinery, industrials, consumer discretionaries. That's the areas that we would be more concerned. But I think tech can still run higher in the current circumstances.
What about consumer discretionary? Any idea? Would you avoid that one, given that people are still nervous about the economy?
Well, the sector's not done bad this year. If it wasn't for tech, and if we were looking at a comparison of the major sectors in the S&P 500 today, the gains that we've seen in discretionaries are not bad. They just kind of look dwarfed compared to what we're achieving with tech and the NASDAQ. But having said all that, I still think this sector is prone to a pullback if employment situation in the States really begins to pull back. And of course, we're going to get the jobs numbers this month or this Friday. If we see a number that's below, say, 170, 180,000, I think that could reinforce concerns about the health of the consumer. So it's a sector I think you want to be careful with right now. I think there's a little bit more value to be had in the staples area of the consumer sector right now. That would be a more defensive play against the potential for deterioration in employment conditions going forward.